Hey there, future investors. Let's talk stocks. It's the stock market, where fortunes are made and dreams are realized. Sound intimidating? Don't worry, I'm here to break it down. We'll navigate this exciting world together. Whether you're starting with a little or a lot, remember, knowledge is power. Think of the stock market as a giant marketplace. Companies list their shares or pieces of ownership for you to buy. These shares are traded daily, with prices fluctuating based on supply and demand. It's like eBay, but for companies. The stock market offers an opportunity to grow your wealth over time. Remember, investing always involves some risk. But with the right knowledge, you can make informed decisions. We'll explore strategies to manage those risks. Ready to jump in? Let's do this. First things first, what exactly is the stock market? Imagine a bustling marketplace, but instead of vegetables and fruits, you have company shares being bought and sold. This marketplace is the stock exchange. In India, we have two major ones, the National Stock Exchange, NSE, and the Bombay Stock Exchange, BSE. When you buy a share of a company, you become a part owner. You participate in their profits and losses. The price of a share is determined by supply and demand. If more people want to buy a stock, high demand, its price goes up. If more people want to sell, high supply, the price goes down. Now, how do you keep track of all these companies? That's where indices come in. Think of them as representative groups of companies. One of the most popular indices in India is the Nifty 50. It tracks the performance of the top 50 companies listed on the NSE. It's like a snapshot of how the overall market is doing. Let's dive into the Nifty 50 and get familiar with some heavy hitters. HDFC Bank and Tata Consultancy Services, TCS, are two prime examples of companies listed on this index. HDFC Bank is a leading private sector bank in India. It offers a wide range of financial services, from loans and credit cards to insurance and investment products. TCS, on the other hand, is a global IT giant. They provide consulting, technology, and business solutions to companies worldwide. Both HDFC Bank and TCS have a strong track record of growth and profitability. Their shares are highly sought after by investors. Why? Because they represent established, well-managed companies with a history of delivering results. Keep in mind, past performance is not indicative of future returns. By understanding the businesses of these companies, you get a better grasp of how the Nifty 50 works. It's like taking a peek under the hood. Now, let's explore how to analyze these companies and the market trends that influence them. Imagine trying to predict the ocean's tides without understanding its patterns. That's what analyzing the stock market can feel like without understanding trends and moving averages. Trends are the general direction of a stock's price over time. Is it going up, uptrend, down, downtrend, or sideways, sideways trend? Identifying these trends is crucial for making informed investment decisions. Moving averages are like smoothing out the wrinkles on a chart. They help you see the bigger picture by averaging out price fluctuations over a specific period. For example, a 50-day moving average calculates the average price of a stock over the past 50 days. This smooths out any short-term volatility and gives you a clearer picture of the long-term trend. By plotting moving averages on a chart, you can identify potential buy and sell signals. When a stock's price crosses above its moving average, it can signal a potential buying opportunity. Conversely, when it crosses below, it might be a sell signal. Remember, no indicator is foolproof. Always use moving averages in conjunction with other analysis techniques. Section 5. The Investor's Toolkit. Technical and Fundamental Analysis. Now let's equip ourselves with the essential tools of the trade. Technical and Fundamental Analysis. Think of technical analysis as reading the language of charts. It involves studying historical price and volume data to identify patterns and trends. Technical analysts use various indicators, such as moving averages, to predict future price movements. Fundamental analysis, on the other hand, is like digging into a company's DNA. It's about understanding the financial health and performance of a company. Fundamental analysts scrutinize financial statements, industry trends, and management quality to determine a company's intrinsic value. They believe that a company's stock price should reflect its underlying fundamentals. Both technical and fundamental analysis have their strengths and weaknesses. Technical analysis is more focused on short-term trading, while fundamental analysis is more suitable for long-term investing. The key is to find a balance that works for your investment style and risk tolerance. Section 6. Diversification and risk management. Safeguarding your investments. In the world of investing, diversification is not just a fancy word, it's your best friend. Imagine putting all your eggs in one basket. What happens if you drop the basket? You lose everything. The same principle applies to investing. Diversification means spreading your investments across different asset classes like stocks, bonds, and real estate. Within stocks, diversify across different sectors and industries. Don't put all your money in just one or two companies, even if they seem like sure bets. Remember, the market is unpredictable. Diversifying your portfolio helps mitigate risk. It ensures that even if one investment doesn't perform well, others can cushion the blow. Risk management goes hand in hand with diversification. It's about understanding and managing the potential for losses in your portfolio. One way to manage risk is to set stop-loss orders. These orders automatically sell your stocks if their price drops below a certain level, limiting your potential losses. Section 7. Nifty 50 Revisited, applying key concepts to HDFC Bank and TCS. Let's revisit our Nifty 50 examples, HDFC Bank and TCS, and see how we can apply our newfound knowledge. From a technical analysis perspective, we can analyze their price charts, identify trends using moving averages, and look for potential buy or sell signals. For instance, if HDFC Bank's price breaks above its 200-day moving average on strong volume, it could signal a potential bullish breakout. From a fundamental analysis standpoint, we can delve into their financial statements. We can analyze their earnings growth, profitability margins, and debt levels. For example, if TCS consistently maintains high profit margins and strong cash flow, it indicates a financially healthy company. Remember to compare their financials with industry peers to gain a relative perspective. By combining both technical and fundamental analysis, we can make more informed investment decisions. Don't rely solely on one approach. Use them together to get a comprehensive view. Remember, investing is not a guessing game. It's about informed decision-making based on sound analysis and risk management. Section 8. Taking the plunge: practical tips for beginner investors. Ready to take the plunge and start investing? Great! Here are some practical tips to get you started. 1. Think of a Demat account as your digital locker for holding shares. A trading account is what you use to buy and sell them. Many banks and brokerage firms offer these accounts. Choose one that suits your needs and budget. 2. Don't just jump into the first stock you hear about. Do your homework. Research companies, understand their businesses, and analyze their financials. There are plenty of resources available online and offline to help you. 3. Don't put all your eggs in one basket. Spread your investments across different asset classes, sectors, and industries. This will help mitigate risk and safeguard your portfolio. 4. You don't need a fortune to start investing. Begin with a small amount that you're comfortable with. As you gain experience and confidence, you can gradually increase your investment amount. 5. Investing always involves risk. Set realistic expectations and be prepared for some ups and downs. Use stop-loss orders and diversify your portfolio to manage potential losses. Section 9. The journey of 1,000 miles. Embracing patience and continuous learning. Congratulations! you've embarked on your stock market journey. Remember, investing is a marathon, not a sprint. Be patient, stay informed, and never stop learning. The stock market is constantly evolving, so continuous learning is crucial. Stay updated on market trends, economic indicators, and company news. Don't be afraid to ask questions and seek guidance from experienced investors. Remember, the more you learn, the better equipped you'll be to navigate the exciting world of investing. So, buckle up, enjoy the ride, and watch your wealth grow.